Hey everybody, this is Greg Gossett, and today is Saturday, September 10th, 2022. I appreciate you coming to the Gossett Trading and Mentoring Weekend Review podcast. Hope you had a good week. It was nice to have the market up for once. I don't know if you remember from last week, if you listened to the podcast, in my opinion, last week, I did think that the market was too low. We were coming into some levels, and I did say last week that I turned bullish on the market and was really glad and happy that we moved up strongly. I'm not always right. I'm wrong often, but I did feel pretty comfortable about that call, and it was good to see the market moving up. So anyway, hope you're having a good weekend and hope you had a good trading week last week and enjoyed some of the up move if you were long. So today, here is the plan and here's the format for the podcast. First of all, I have to run the U.S. legal disclaimer. Secondly, we're going to come back. We are going to take a look at my current positions, both opened and closed. We're going to talk about when I bought them, why I bought them, and how I am going to manage them moving forward, either to the upside or to the downside, or why I closed out some position as well. After that, we're going to spend a few minutes and talk about trader psychology, always the most important part of trading. It really is. I think it's honestly about 90% of your trading. Pushing buttons, knowing where to buy and sell, not that hard once you learn a good process, but sticking with your plan, keeping your emotions in check, not letting your emotions get amplified in a negative way, and sticking with the plan and the process. That's what it's about. So I always like to talk about trader psychology for a little bit. It's good for me. You always need to teach, or you always teach what you mostly need to learn. I always remember that statement. It really does make sense. And I'm pretty good at charting. I'm pretty good at technicals, but like a lot of people out there, dealing with the emotions, following the process is the most important part. So, it's a thing for me. It's an important thing for me. I have struggled with it over the years, to be honest with you. But that's why I like to talk about it. It helps me, and I hope it helps you as well. After that, we are going to read a poem from my good friend Frank, the trading poet. I always think it's kind of fun, and he's an amazing poet, amazing author, amazing journalist, and trader and musician as well. And he always writes something that's pertinent about really what's going on with the market, so we'll do that. After that, I have gone down through my watch list. I have identified what do we have? 1, 2, 3, 4, 5, 6, 7 potential trades that I'm looking for next week. This market, this bounce that we've had is pretty interesting bounce. And I went through my watch list and I had a hard time finding something that really looked good, because we've had this bounce, we've moved up, we're kind of in no man's land in my opinion right now. We could either continue to go up, we could go right back down, just like any day in the market, but I'm not as confident right now after this bounce that I was last week when I got bullish. I mean, is this just a bounce? Is it going to turn into a squeeze? Don't know, but I did identify 7 different stocks next week that I'm interested in, and I will be going over that, and we'll take a look. We'll see. I usually need something, a stock to go up further or down further for me to get interested in, and that's what that's what I'm looking for. That's what I've identified, and that's what I'll be looking for next week. And I hopefully you can follow along, and it'll be helpful for you. And then also, I'm going to go over the indexes as well today, just from a technical standpoint, and because they're going to lead the market in general as well. So that's the plan for today. Hope that's okay. Hope that's going to work for you. And before we get started, I have to run the U.S. legal disclaimer. So hang tight, and I'll be back in 40 seconds. Thanks a lot. U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation, and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you. All right, I said 40 seconds and that was like 2 minutes. Sorry, I ran the other closing disclaimer. Hope it's okay with you. All right, let's get started. Let's start with the open positions. First, I did buy Coca-Cola back on the 6th of September and pretty clean, easy, deep dip buy purchase here. I bought it when it bounced basically right at the 200-day moving average. I noticed that the day before it also had an intraday rejection of the 200 and also closed back above the negative third ATR channel. There's generally, not always, but there are buyers, deep dip buyers that come in at the 200-day moving average. It gives them a good risk to reward ratio. And that's the whole thing about trading. Finding a level, look for a good risk to reward ratio. Position size based upon volatility, set your emergency stops, set your end of day stops, set your profit targets, all the stuff that I do. And by the way, I do teach private one-on-one lessons in the evening time via Skype. I think the best way to learn anything is one-on-one from your instructor. I will talk about it near the end of the podcast, but just wanted to point it out here. If you're interested, emails is in the description of this YouTube video, and you can reach out to me. It's a great course. I promise you'll be glad that you took it. But in the course, I do teach that 92% of prices do bounce or stop going down at the negative third ATR channel. So you can see the day before I bought it, it went below, back above, also rejected the 200-day moving average. I decided to give it one more day to see if it would hold, and it did. So I bought it at the close. Of course, I buy my swing trades near the close of the market because the large financial institutions come in at the end of the day. I consider them the smartest money, and what the close is very important. So I wait for the end of the day to see what the large financial institutions are doing, see if levels are holding, and it did. So I bought it here at 61.11. Nice little entry. I think I'll just I'll do that when I get to VIX here. I do have this orange line up here. This is 1.5 ATRs from my entry. Once it gets there, then I go into trailing stop mode. So if I get a close below a previous day's low now, I will get out of half of my positions. Also, I take partial profits whenever one of my positions goes up a certain amount, which is 0.45 ATRs. Right now, 0.45 ATRs is 42 cents. So Monday, if we move 42 cents from the close, I will get out of 10% of the position that I have left. If it goes up another 42%, 42.42 ATRs from there, I'll get out of another 10%. If it goes up another 0.42 ATRs from there, I'll get out of another 10%. I like to play offense and defense. Emergency stops defense. Here's emergency stop. I always put an emergency stop 2 ATRs below my entry. End of day stop would be, why did I get into the trade? I got into the trade because it held the 200. If it closed below the 200, I would just get out. But the 2 ATR emergency stop, I would get out of anytime. The end of day, I have to wait for the end of the day. So the emergency stop, the end of day stop, that is a defensive measure. But taking profits as it moves up, taking those partial 10% profits, that is playing offense. And I like to play offense and defense. In any sports, you need to play offense and defense. So anyway, it did get to my trailing stop level, which is nice. So now going forward, if I get a close below the previous day's low, I will get out of half. If it came down close below the 200-day moving average, I would get out of the other half. And I have an example of that happening with Tesla. That's a good teaching moment. So this particular trade is up from entry on the remaining shares that I have. 1.53, or sorry, I need glasses. 1.93%. So not a bad little return in 2 days. It was a good risk reward ratio on a strong company like Coca-Cola. NVIDIA. All right. I did buy NVIDIA on the 8th of September, 2 days ago. Why did I buy NVIDIA? Well, we went intraday under 30, over 30. We also closed over the previous day's high. I like this sideways motion here. It stopped going down. Of course, I have my emergency stop, 2 ATRs below my entry. What is my end of day stop? Well, why did I take the trade? I took the trade because it went intraday under 30, over 30. Therefore, if it closes back below 30, that will be my end of day stop. If you notice, here's the negative 30 ATR channel. We did close above that, which is another great sign as well. So I've only had this trade 1 day, but from entry to current price, up about 2.68%. So not too bad. Now the orange line up here is my trailing stop level. Have not reached that. So if I get up there, if we get up there eventually, then if I get a close below the previous day's low, I will get out of half, but it is not there yet now. So I'm exclusively concentrating on the emergency stop and the end of day stop. And again, the end of day stop is a close under the 30 RSI. I did take a new trade on Friday with VIX, volatility VIX, and reason I took the trade, well, we bounced at the negative third ATR channel. We also went intraday under 30, over 30. We had a V1. V1 consists of 2 bars. Here's bar 1, bar 2. Bar 2 went under bar 1 a little bit, closed above the close. That is an entry trigger. That's something that I teach in my course. And let me just go over quickly, since this is the brand new trade, how I would position size for this. So a good rule of thumb is risking 1% of your total capital on any one trade in the worst case scenario. That's my emergency stop. So, if you had $50,000, 1% of that would be $500. What I do is I take $500, I divide it by the value of the 2 ATR, which is $1.44. That would tell me to buy 347 shares. Now, if you had a $100,000 account, 1% of that would be 1,000. Divide that by the 2 ATR, 1.44, and I know it's going to be double, and it is 694. So I'm not saying buy, 500 shares of this or 200 shares of that. It's all related to the capital you have. But a good rule of thumb is 1%, right? If you had $1 million, you could risk, in the worst case scenario, 1% of that. It's not fun to risk 1%, but it's not going to destroy your account. I don't even use 1%. I use about 0.5% on any one trade. So once I know how many shares to buy, then I have to place my emergency stop. Well, here's my entry, 1847. Remember, in that hypothetical, I didn't want to lose more than $500, right? And we better do the math one more time. We'll start over. 500 divided by $1.44 is 347 shares. Now, if I take 347 shares, times $1.44, well, that's my $500, right? Because I just did the math, 500 divided by 144. So I place my emergency stop exactly $1.44 below my entry. If it gets there, how much have I lost? I've lost $500. That's a very small amount of my account. I can afford that, right? But that is in the worst case scenario. My end of day stop is, again, the opposite of why I took the trade. Well, it went under 30 and over 30. So if my end of day stop is a close under 30. Makes sense? What's the orange line again? Orange line is exactly 1.5 ATRs from my entry. Once I get there, I will go into trailing stop mode. So this trade basically unchanged. So the open trades, Coca-Cola is up 1.93%. NVIDIA up 2.68%. VIX unchanged because where I bought it. Now Apple, these are closed trades. Now I did buy Apple back here on the 7th of September with a close under, close over the 300-day moving average, which is a good valid signal. So emergency stop was down here, but if I took the trade because it went under 300, over 300, how am I going to get out of the trade end of day? Well, next day it closed under the 300. Now, do I wish I would have kept it? Of course, because Apple went rallying up nicely, but that's just one of the things of trading. There will be times where you take your stop loss and it will just go roaring up and you're like, why did I take my stop loss? Right? But there are times where you're going to take your stop loss and the next day it's going to go down and down and down and down and down and down and down. And you're going to be so glad that you took it. But yeah, it's unfortunate. Yeah, if I would have kept it, it would have been up. But this ended up being a loss. I have to follow my process. It was a loss of 0.98%. Not too bad. So I am out of this trade. Now, Tesla. This is an interesting position here. It ended up positive, but I did short back here on the 25th of August when we had a lower close below the 200-day moving average. Now remember, I always take partial profits when it moves my direction, right? 0.45 ATRs or greater. So I shorted at let's see. 297.03. Shorted at 297.03. Immediately went down. Down, took some partial profits. Down, took some partial profits. Down, took some partial profits. Also got to my trailing stop level. So now if I get it, I'm short on this trade. So if I get a close above the previous day's high, I'm going to get it out of half. Went down the next day, went down the next day, hit some profit targets, right? Next day opened up, down, profit target. So I took a lot of profit targets off while I had them. Now here, because I got to my 1.5 ATR trailing stop level, then I had to close above the previous day's high, which I got out of half of my position at roughly, I have this written down, this is ballparking here, but roughly about 4.89%, right? So I took profits off on the way down into weakness. That's playing offense. Got to my trailing stop level, then had a close above, locked in on the remaining shares, a gain of approximately 69%. And then my end of day stop, well, why did I take the trade? Because we closed under the 200-day moving average. And then on Friday, we closed back above. So on the remaining shares that I have, which were not a lot, right? Because I took profits, covered on the way down, covered half of what I had remaining due to my close above the previous day's high after reaching 1.5 ATRs. And then here we close back above the 200. So on the remaining shares, I got out of a loss of 0.93%. So all in all, this was a very profitable trade because of taking the profits, using my trailing stop levels to lock in, and then the remaining amount I had lost 0.73%. So pretty interesting. I thought that was a good teaching moment of why it's important, or why it can be important to take profits, have trailing stop rules in case something, because this was up like 10% at one point, and then, it gave it all the way back up, but it didn't because I took profits on the way down, took half when I had to close above before this rip roaring move back up. All right, so those are the positions. Let's quickly go over, talk a little bit about trader psychology. Here we go. One of my favorite channels over on Twitter is Money Trade Edge, Better Thinking, Better Trading. Please follow him. It's a great post. Has a picture of Axe here from Billions. But he posts great information, and follow him because whenever I see a post from him, I'm like, oh, ooh, I love these posts. Let me read. Let's see what he has to say today. 90% of traders can become successful traders just by following their rules. You know, if you have a good trading approach, good risk to rewards, position sizing based upon levels of support, it's not that difficult. The difficult part, everyone, is people break their rules, and that's what makes it difficult. If you just say, okay, this is what I'm doing, this is my plan, and then you have to follow your plan. A plan doesn't work if you're not following your plan, right? So 90% of traders can become successful traders just by following their rules. So if you have rules, follow them. For God's sake, just do it. Yes, there's going to be times where you're like, oh, I had a feeling I should have gotten out. Oh, I should have gotten out, and it went down, and so forth and so on. Of course, that happens to all of us. But there are times where you will get a huge move up like we did in the summer. We had that big squeeze that if I guarantee you, if I would have just followed my rules on a bunch of things, I would have made a lot more money than by getting out early. So it is true. You know, when you don't have a position and you write down your rules, you're thinking very objectively, and that's the best spot to be in. As soon as you have a trade on, then you're thinking changes because you have a dog in the fight, right? And I hate that saying because I would hate dog fighting more than anything. I should come up with a different one than that. I apologize. But, you have skin in the game, right? And then sometimes skin in the game affects your thinking and your decision making. So my advice is if you have a good trading approach, which includes proper position sizing, good risk to rewards, levels that you're keying off of, try it for a week, try it for a day. Just follow your dang rules. Like he says, 90% of traders can become successful just by following their rules. And there's something kind of, insult to injury when if you would have followed your rules, you would have made so much more money. And you're like, God, I didn't even follow my rules. Like, it was part of my plan. Why didn't I do that, right? We all go through this. But if you have a good trading plan, just follow it. I know you're going to make more money. All right. Now, before we get over to taking a look at potential setups for next week, I was talking before about my the trading poet Frank at Franco D over on Twitter. Follow him. He has such great poems every day. I always look forward to this. Let's see what Frank has to say today. Speed bumps and potholes pave the market's road. Traders understand this. It's their work abode. They manage it using a system kind of like a code. Still, it's best to travel without a heavy load. Isn't that nice? Speed bumps and potholes pave the market's road. There's plenty of speed bumps and potholes in the market. Traders understand this. It's their abode. It's their house. It's where they work, right? They manage it using a system kind of like a code. Still, it's best to travel without a heavy load. And I like this. They manage it using a system kind of like a code. I was just talking about in trader psychology about getting a plan and sticking with your plan. Thank you so much, Frank. Really appreciate that. Please follow Frank at Franco D over on Twitter. All right, here we go. Like I said, I do have 7 symbols here. A lot of these are kind of retracement signals. I need them to come down before I really can do anything. Like I said at the beginning of the podcast, where we are with the market with this pretty significant 3-day rally that we've had, it doesn't offer a lot of great setups, in my opinion. I mean, I kind of searched high and low, and really what I came up with is I think the only potential setups I'll be interested in next week are going to be ones that have a retracement. So let's start with Goldman Sachs. Well, 2 days ago on Thursday, we popped over the 200-day moving average. Pretty good, right? Friday followed through. It would have been a good trade. I saw this. I didn't take it. But on Goldman Sachs, what I'm really looking for here is we came from a lower low and closed over the 200-day moving average. My favorite 200-day moving average buys are where you close under, you close over. A lot of times it comes back one more time, making a higher low than the previous low and then back over the 200. So same with Coca-Cola. I was waiting for 2 days of test of that 200. Goldman Sachs may just continue to crank up. I don't know. I really don't know, of course. If I did, I'd tell you. But it's also very likely it will come back and test that 200-day moving average. I wouldn't buy it here. The risk to reward ratio isn't good. In hindsight, yes, I would have bought it here at the 200 because the risk to reward from the close to the 200 is pretty good, but I decided to let that one pass. The other thing is we have this big down bar here on the 26th of August, this big, huge down bar. Well, what happens with big, huge down bars? My students know that a lot of times you will retrace back up and get stuck right at about 50%. See the big down bar? I drew this line here because look, we closed a little over it, but that's really where it got. Look at the day back here on the second big down bar. We got right to the halfway, failed. Friday, about halfway stronger because it didn't fail. But this concerns me to the fact that I believe it's possible that we could come back down and test the 200-day moving average. So that is what I'm looking for next week, is a retest of the 200-day moving average. Lockheed Martin. Well, Lockheed Martin had a nice return to value sideways motion, had a V1 entry on the 7th. I did not take it. A V1 consists of 2 bars, bar 1, bar 2. Bar 2 has to go under bar 1 by at least a quarter ATR and then close above bar 1's close. It also rejected the 50-day moving average, which I like as well. I did not take the trade. Next day it came back down, tested, reversed, went up, and Friday it was up, not a lot, 0.4%. But what I'm looking for here is, you see the halfway of this up bar should act as some kind of support. And you can see the day before it did act as support. Intraday it went under, but it closed back over. What I would be looking for on Lockheed Martin, because Lockheed Martin has been relatively strong compared to the rest of the market. It's not near the 200-day moving average. It's still above. It's above the 50, which is kind of hard to find these days. So what I'm looking for on Lockheed Martin would be a test of the 50 SMA here, which would also bring it right in line with a test of halfway of this big up bar. So I'm looking for some kind of basically retest of the 50-day moving average and or retest of halfway of this big up bar, and giving me a better risk to reward ratio. So if we came back down and basically closed right at the 50, I would buy it, because my stop is going to be a close below the 50, giving me a good risk to reward ratio. So that's what I'm looking for on Lockheed Martin. And I do like the fact that Lockheed Martin has relative strength compared to the rest of the market. Morgan Stanley, well, same as Goldman Sachs. We closed above the 200 and continued up. We did make it much higher above Morgan Stanley of this big down bar here. But what I'm looking for in Morgan Stanley would, as with Goldman Sachs, would just be another bounce or intraday rejection and or close under, close back over the 200-day moving average. Philip Morris. Well, Philip Morris did poke its head above the 200 barely. The 200 is 96.97. It's 97.06. So it did close above the 200-day moving average. This would have been a valid buy on Friday, but I did not buy it because I really don't like buying closes back over the 200-day moving average when they come from way below the 200-day moving average. I want to get a higher low close above the 200-day moving average. So in other words, we closed below down here. We closed above. I think there's a good chance we'll close back below the 200 and then close back above, but it will come from a lower high than this lower low. So I'm looking for another pullback, intraday rejection of the 200-day, where intraday it goes below and then closes back above, or just a close back below and then a close back above, because that would give me a higher low close back above than this close above that came from a lower low. TLT is interesting. Very similar to NVIDIA that I bought. Yes, we've come down. We're very, very low, but we have in the last 4 days moved sideways. I like that. It's showing that there is some support here. There's a gap, a big gap here, which I think has a good chance to get filled. The question is, where do we get in on this? Well, it's a 36.46 right now. If I had a nice V1 or V2, a V1, Monday would have to go below Friday's low and then close back above. It actually was a V1 on Friday, but I'd like to see more of a washout, maybe wash out this low and then have a V1 or a V2 entry to the upside, and or an under 30 over 30. So for me, a retest of this low with the V1 or V2 and under 30 over 30 is what I would be looking for to get long on TLT. And TLT, I mean, look at this move down, big, big, big. But we also did run some liquidity. We tested the previous low back on June 17th, which, is good. So we have tested below, set off a lot of sell stops. It has recovered. So just looking for a V1 or a V2 or an under 30 or an over 30 to get interested in TLT. Twitter, well, Twitter has had a nice 3-day move up above the 200-day moving average. We're coming into some value gaps over here. I would be hesitant to buy Twitter right here at this point, but you can probably guess it. I am looking for a pullback and a retest of the 200-day moving average. And then last but not least, we have oil. Well, oil closed under the 200. Friday, it got above the 200, but closed below. Remember, that's what I'm looking for. All it did was close this gap. But I would love to see USO pull back, give me a higher low, and then close back above. So a higher low close back above the 200 would be interesting to me. A 250-day SMA intraday rejection. I think Paxton bought oil here back on Thursday with an intraday rejection of the 250. And if that's the case, he did really, really well. It's one of my former students, up 4.42%. If you're out there, Paxton, good talk, or haven't talked in a while, and let's catch up soon, because I'd like to catch up and see what's going on. But I think I did see that you possibly bought this off of the 250. Not sure, but I hope you did. But if it came back down to the 250, I would be interested. If it came down to the 300-day SMA, I'd be interested. And if it also could close above the 200-day, I would consider it, but it would be a lower. It would be lower close above the 200. The best thing that could happen would be us go above the 200-day moving average, come back down, form a higher, and then go back above the 200. So let me clarify that. If we could close above the 200, then close below the 200, then close above the 200 again, giving me a higher low close back above the 200. If it closed above the 200, I would consider buying it. I would just have to see what it looks like at the end of the day. So that's what we have. That's what we have. That's what I'm looking for next week. I do want to quickly go over the indexes, because this kind of rules everything, right? The indexes. So, of course, we had this huge move down, right? We changed market structure here at the low. We moved down. We've had a nice rally, but we are in a lot of resistance right now. We are at the -1 ATR channel. We're at the 20 SMA. We did make it above the 50, which is good, but we have this big gap here. And then we have an order block over here. And if you don't know what an order block is or gaps, please refer to ICT Mentoring on YouTube. My good friend Ava did kind of turn me on to these fair value gaps, order blocks, and they're powerful. They really are powerful. And you can find that all for free on YouTube under ICT. But so going forward to the upside, the reason I'm a little hesitant, I was very bullish down here, right? But I'm a little hesitant here because we're coming into this gap. We're coming into this order block. And we have to decide, is this just a bounce that's going to fail, or is it going to become a squeeze? for people to get short. I don't know, but I'm just we're running into resistance, and so that's why I did not take any trades on Friday and actually added the VIX. So yeah, we could continue to move up, but we have the gap, we have the order block, we have halfway of this big down bar. If we do rally, if we continue to rally, I think probably a decent spot where it would probably find some resistance would be about 313, but that's still 6 points up there. So there definitely is room to move, but I'm not as bullish as I was last week on the Qs. Now, SPY is going to look the same, almost exactly. It's been a little bit stronger, but here we go. Same thing. We have a big order block right here. We have halfway of this bar. We also have the bottom of the gap down here, which it did make it above, but you know, when you see these order blocks, you can see a lot of, not the order blocks, but when you see the fair value gaps, a lot of time, as soon as they get into them, they stall or go back down, and we are in one. So I'm just a little hesitant, and that's why I did not have too many potential setups for next week based upon what the SPY looks like. And then lastly, IWM. Same situation, right? We have the order block over here. We have one big old gap here, a fair value gap. And a fair value gap is basically a 3-bar formation where you have bar 1, 2, 3. You take bar 3's high and bar 1's low, and see how that creates this big gap in here where price has not been tested efficiently. So there's a good chance we can get up into it, but there's also a good chance when we get into it that we're going to come back down. And even without gaps and all this kind of stuff, you know, what's the old saying? The old saying is sell rips in a downtrend and buy dips in an uptrend. Well, right now, technically, this is a downtrend. So a downtrend associated with a gap or a fair or an order block over here is concerning. So I'm not shorting this. I'm not doing anything with this. But I just, you know, like to look at the indexes to help kind of guide me on my individual stock trades. And that's why I did not take anything on Friday other than the VIX. So anyway, that's it for today. I appreciate you coming by and listening. As I mentioned at the beginning of the podcast, I do teach private lessons in the evening time via Skype, one-on-one. I teach the five different setups that I use. I've been teaching for many years. I've taught people from all over the world. I've had so many good reviews and feedback from my students. If you really want to learn step by step how I do this, position sizing, entries, exits, emergency stops, everything. I teach you everything. I teach you everything that I know, and I know if you take the course, you're going to become a better trader. The course is $1,750. It's substantial, I know, but it is worth every penny. And remember, you are getting a one-on-one coach for 15 total hours. So if you're interested, email's in the link of the description. Just send me an email, say, Greg, potentially interested in taking your course. I'll reply and say, hey, that's great. Let's set up a Skype call. Skype call is free. It's not a sales call. I just would like to get to know you better, answer any of your questions about the course, learn more about you, your trading goals. And like I just said, it's a great time for you to ask me questions about the course. When we're done, we're done. I will not contact you. You'll have to contact me. So if you're interested, send me the email. Be fun to chat with you on Skype. And I think you'll be glad to take the course. I really do. Secondly, I have a really good online teaching course on the deep dip buy stock trading strategy. It's available at udemy.com. It's a great course. I've had so many good reviews from all over the world. So a lot of those courses, because the price is right, man. The price is like $12 to $15. That's it on Udemy. And you get 9.5 hours of video. You get 26 total videos. You get 15 study guides. And it is a great place to start, especially if you're new to trading or an expert at trading. It's a great course regardless, but if you're a beginner, it's a great place to start because the videos show exactly how to do it. I'm OCD. I repeat things a million times, and I know that can be annoying, but when you're trying to learn something and you get you get your teacher telling you and telling you and telling you again, it kind of fills in those gaps. And so that's how I teach. That's how I like to learn. And that's why I teach it. I teach it that way. So if you're interested in that course, like I said, it's between $12 and $15. It's on udemy.com, and the link's in the description. And then lastly, I guess I should say 4 things. Third thing is, if you like today's podcast, I would appreciate it if you could give me a thumbs up. It helps the channel out, lets YouTube know that there's some valuable content here so they can get it out and share it. So, if you like today's podcast or anything in the past, I would just appreciate if you take a couple seconds, hit that thumbs up button. And then number 4 is, please go out and try to do 2 nice things today. Try to do 1 nice thing for another human being, 1 random act of kindness for another human being. And if you could, mean a lot to me, if you could go out and do 1 nice random act of kindness for an animal as well, that would be wonderful. It would make the world a better place if we all treated each other better and did random acts of kindness both for animals and humans. I was raised with lots of animals. They appreciate random acts of kindness just like we do. And who knows, one day if you need it, hopefully someone or an animal will be there for you as well. So that's it for today. I'm glad I got through this without coughing. I had COVID and I got over COVID, but I still have that tight little cough every once in a while. But it looks like we made it through okay. So appreciate you coming. I hope you enjoy the rest of your weekend. I hope you have a good trading week next week. Please follow your rules, right? Follow your rules. Concentrate on risk. When you're supposed to get out of something, just go ahead and get out. Be particular with your entries. Look for good risk to reward ratios. That's what it takes, everyone. It's what it takes. So thanks for your time. Enjoy the rest of your weekend. Have a good trading week next week. If you have any comments or questions, just leave them down below in the comment section. I'll do my best to get to them. But thanks again. And on the way out, I'm going to have to run the U.S. legal disclaimer again. So appreciate you hanging on for that. All right. Take care, everyone. And we'll talk to you next week. Bye-bye. U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.